not all brokers are like this, just kind of talking about how bad this broker was. She sent me the summary. I looked at it instantly. I saw like they can't qualify on the A side. Like they're automatically an alternative client and they didn't have 20% down. So like I looked at it for 10 seconds and was like, yeah, they're not qualifying. They can't get approved anywhere. Like this isn't happening. She's like, what?
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren.
Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name is Paul Stevenson. I'm a Level 2 mortgage agent, and I'm joined by David Warren, a Level 2 mortgage agent and owner at Referral Mortgages. This is episode 251.
Yay!
Yay! We were going to do a big thing for 250, and then I ended up doing that one alone. So I was a solo 250er, and now 251. Here we go. Yay!
Yeah, whatever.
Thank you to our amazing sponsors, and thank you to you, our amazing listeners, for subscribing, for listening, for tuning in every week. Last week, just to clarify, Dave and I were both at the Centum National Conference. It's a vision conference. We go every year. It's kind of their once-a-year annual conference. It was held last Wednesday. So we had all plans to record and do things on different days, and everything just kind of went to shit. So we apologize. We're here. We're back a day late, not a dollar short. We're ready. We're back. We got lots of info, hard-hitting news. And here we go. Dave, how are you? You're in Florida.
Doing well. I am.
You got the warm weather.
Yeah, we came here a little bit early for March break. Yeah, just working from here. Haven't really seen outside yet much, but all is good. All is good. Came back from Toronto. I ended up being there a little bit longer with meetings and whatnot, and kind of came back to Ottawa and on a flight to here. But we're here.
I pulled the old in and out. I pulled the in and out. I came in Tuesday, stayed with a friend, left Wednesday. I was just boom, boom, back in action. Market it's definitely a spring market. I don't know what happened this weekend. I mean, I know clocks went ahead. The weather got warmer and people decided, hey, the snow's gone. Hey, what's our summer looking like? Hey, let's start looking at homes, and people started getting a little more aggressive. It feels like the last 3 weeks, the market has really picked up. And I would say now we're March 11th recording this. So, we're really getting into that peak season where people are thinking about those May, June, even April. April's kind of a very busy month right now for closings. What are you kind of seeing in the market, Dave? What sort of stuff's coming across your desk right now?
Certainly purchases, seen more purchases. Again, that is certainly a change from February where it was lighter on that front. Continuous conversations still revolve around existing clients up for renewal or existing clients referring their friends or family that are up for renewal. So a lot of conversations still around that, around refinances or debt consolidation, or as they're up, like, shopping for best rate. But also I spoke about this last week at the conference we were at, but a lot of conversations were just around not just rate driven, but around what are they, as they're coming up for maturity. Incomes have gone up, but so have living expenses. So, their kids are now 5 years older. They're getting into university, or that's on the next horizon of the next 5 years of their term. So thinking about kind of that forward out, but also needing to, look at more so their budget and cash flow. So really kind of looking at debt consolidation, looking at extending that amortization to fit within that budget and those goals. And so those can still drive those conversations that I'm having. Yes, purchases and purchase agreements have picked up as far as that influx in the last couple of weeks, but those renewal conversations kind of still kind of drive my day to day.
Yeah, good point on the renewals, and also something that I learned at the conference. I mean, kind of assumed already, but learned that more people are dealing with is that clients now are not like, you can go online and you can look at rates, and most of them aren't available to you, but they're there. But most people are coming to brokers for advice. Like they just need to know, like, their situation's wonky, their income's changed. They started a new job since they bought the house. Their husband lost his maybe, and they have all these new debts that they have to try to cover the living expenses over the last couple of years. So there's all these unique nuances to every single conversation. And the impression I got last week, and actually over the last couple conferences that we've been to, is that the stats are showing that the majority of people that are having these mortgage conversations are now dealing with brokers because they understand that there's a different level of advice there and support and expertise, essentially. So I found that interesting. I mean, it's good to know that people are understanding brokering, because I know when we first got into the industry, it was still kind of stigmatized, like you're dealing with a broker. Why would you do that? Like people didn't understand it. They thought there was huge fees. They thought that their credit was going to get ruined. Like there was all these myths about
Mhm. You only went to a
brokers.
broker if you had shitty credit or you had a shitty
Exactly.
situation, and that was it. As opposed to like you were looking for like tax structuring within your business and like other programs like that,
Yeah.
so you can not be kind of paying tax or shopping to a banks for better rates as opposed to just walking into your local branch. It was really interesting, from 13. It's amazing how things have changed over the last 13, 14 years.
Yeah, everything. And I had a clients that gave me like a long summary of their situation. They've been dealing with a broker for a week and a half, hadn't gotten back to them, had no communication whatsoever, which I mean, this isn't helping my case as far as brokers. Not all brokers are like this, just kind of talking about how bad this broker was. I looked at it instantly. I saw like they can't qualify on the A side. Like they're automatically an alternative client and they didn't have 20% down. So like I looked at it for 10 seconds and was like, yeah, they're not qualifying. They can't get approved anywhere. Like this isn't happening because like it's likely they may not get approved even for XYZ reasons, It's like all these things that you could look at in a snapshot that, I mean, they said broker, could have been, I don't know, could have been a bank. I have no idea, but she just said the other person they were dealing with, they hadn't heard from. But we do hear that all the time. People are like, oh, I went into my bank. I haven't heard from them in 2 weeks, or I heard from them a week and then my advisor left for vacation or whatever. There's always these things that happen. We work pretty much 24/7. Like I was responding to that not that I'm going to always respond at 10 p.m. on a Friday, but in this case, it was urgent and it was just like a quick response. But that just kind of leans into that knowledge that brokers have that other people in the industry may not, just because we have that kind of nuanced approach of advice and just understanding the situation and just what would I do? What would I do if this was me? And that's I think a good way to approach it if you're an advisor.
I think to that point of what's going on in the market, I'm going to try segueing this.
Yeah.
But we're talking about renewals, we're talking about purchases. Even if you're out shopping or you're up for renewal or you're not sure what you're thinking of doing in the next 120 days, right now with the new geopolitical landscape and our latest war, that's not a war.
It's a conflict, David.
It's a conflict.
It's a conflict.
Just like we're not in a recession.
Nope, not here. Nothing to see here. Everything's going great.
But we've seen in the last week, and people are feeling it at the pumps for sure, is, oil is up 77%. I think it was up 11% yesterday alone. We're over $100 a barrel. And this is driving up, obviously, prices at the pump. This is driving up the bond market, which is and we've talked about it before at nauseum. If you listen to the show, that fixed rates are tied to publicly traded bonds, that as they go up, so do fixed rates. As they come down, so do fixed rates. Obviously it's not in lockstep every single day that they're changing rates because they wait to see if things like stabilize before, no bank wants to be changing every single day. But as bonds have really come up in the last week, and they've come up 0.3% or 30 basis points, which is massive. And so we've been seeing fixed rates come up every couple of days, really. And there was another jump last night by a number of institutions from 0.15%, some at 0.05. So we've, really in the last week, we've seen a number of institutions come up quite a bit, not a full 30 basis points. They're trying to absorb that in hopes to keep rates low. But really with like oil coming up, and that pressure, and it's driving the bond market, that if you have an offer for renewal that is starting in the threes, you should take it now. You're not going to find better right now on the market. If you really, if you have that, like, make sure they don't pull it on you and increase it. Like, it's something you might want to lock in now. If you're not needing to change anything with your mortgage, if you're not needing to extend an amortization or anything like that, because rates have bumped by and large across the board on insured mortgages. They are bumped up above 4% in the last couple of days.
Yeah, my thinking, I completely agree. And I mean, even if you lock it in now and rates do come down again, as we mentioned on the last few episodes, like you can request to have your rate reduced to that rate in the coming weeks if that happens. My opinion, I mean, I can't deny, obviously rates have gone up, bonds are up. I think this conflict is nearing an end. Now, is it going to end soon? Today, maybe. Tomorrow, maybe. I think it'll be by this time next week when we're recording. I think it will be, at least deemed done, whatever that looks like. So I think like in a month or so, we will see rates. At least I don't think they're going to go much higher than where they are now. I think we might see bonds come down. Lenders, as we know, take a while to adjust on the way down, not so much on the way up. So like you said, bonds go up. Some lenders raise their rates the next day. Others waited a week or so and then raise them, but they do raise them. On the way down, it's usually a bit slower, usually a bit of stagnation there. So I would say in the next maybe 3 weeks. Now, I'm not advising clients of this, but just saying my personal opinion, not official financial advice. I think we may see rates come back down after the conflict, right? Once everything settles and so on. But who
Yeah.
knows? I mean, it could be a month. I'm saying a week. It could be a month. It could be 6 months. It could get even bigger, right? It could escalate, but
I think it really depends, what happens with this conflict and with the really more so in that Strait of Hormuz, and really, 20% of the global oil market flows through that waterway, which is completely choked off right now. So that's what's driving oil prices. But the reason why I say that at the outset is, when you feel it at the pumps, is that drives inflation numbers. And so as that's jumped up, and I know in Ottawa here, we were around the like $1.30, $1.25 a liter kind of range. And now
$1.50 even.
now we're at
Oh,
$1.50.
yeah.
Yeah. A week and a half ago, we were around $1.25, between $1.25 and $1.30. We're now at 150. And you saw it in Toronto. It was above that. I think around $1.60. That drives inflation. And so if this conflict extends, and for an extended period of time, and the waterway doesn't open up, and oil production and supply doesn't come back to the market to drive oil prices down, oil is a big underlier for inflationary numbers, which is then going to put pressure on the Bank of Canada and central banks to look at, it's going to bump up inflation numbers, and it's going to have an impact on the overall market, which is going to put pressure on, do they do something, do they hold and wait, knowing that it's this conflict that's, and these oil prices that are driving that one area, or does it ripple, because oil obviously impacts, food prices, and it impacts everything, because obviously oil is needed for everything that we do. But it will put an interesting pressure on the Bank of Canada as to not the upcoming decision, March 18th. They're going to maintain as they are. There's not going to be any change. There's not enough data for them to make any movement. But in future decisions, how that, if the numbers for the oil prices kind of do start driving up inflation and an impact in the overall economy, that's going to change things as far as what perhaps they do.
Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free, unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca. Even the best photographer can't hide drywall dust and paint splatter. And every day you delay listing could mean missing peak spring pricing in Ottawa. A to Z Cleaning Expert gets your property truly photo ready. Don't risk going to market half ready. Mention TOREP at a2zcleaningexpert.com to receive priority scheduling for your next listing. Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big, protect what matters most. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction at Gertin-Poirier Avocat Lawyers. We love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you for an effortless client experience that opens doors. Call us at 613-744-4488 or visit our website at gertinpoirierlaw.ca. Let's get to the heart of your deal. This episode is brought to you by Easy Neon Signs. Visit easyneonsigns.ca and use the promo code TOREP, TOREP, to get 20% off each and every order. easyneonsigns.ca. Canada's finest custom neon sign maker.
Yeah, the other thing that is that I was reading with regards to rent, I mean, this is all relative with regards to inflation and everything else, but the Canadian rents have fallen for the 17th straight month, which is, that's a pretty big number. That's not, it's not 5 months, not 6 months. It's almost a year and a half now. This was an article from Canadian Mortgage Trends. It just says average asking rents across Canada declined again in February, marking the 17th consecutive month of falling rental prices, bringing the national average to roughly 2,030 per month. While rents remain historically high, the trend suggests the rental market is gradually cooling after the extreme surge seen between 2021 and 2023. The declines have been driven primarily by softening demand in major urban markets and an increase in available rental supply. Condo rentals in particular have seen some of the largest price adjustments, while purpose-built rentals have been more stable, but still trending lower and lower every year. That was something that I found very interesting too, Dave. In the Mortgage Professionals Canada Symposium here in Ottawa, we had Sean Cathcart on, who's actually coming on in 2 weeks' time with lots of stats. So for all those stats people, have lots of historical data. But he was talking about how the majority of buildings being built right now in Canada are purpose-built rentals. I mean, we've seen that in Ottawa directly. We talked about all the high rises down on Preston and so on. Like they're all purpose-built rentals. The ones at Blair, they're just a lot of rentals being built. And he was just explaining that this is creating like a massive delta in the market where, there's just no really entry-level homes for, I mean, there is in Ottawa, because he said Ottawa is very good at building those kind of row townhomes. But in cities like Toronto, Montreal, Vancouver, like it's just all purpose-built rental high rises, which doesn't lend first-time home buyers, doesn't lend to people trying to downsize. There's just kind of this big gap in the market between single-family homes, starter homes, and everything in the middle is just kind of gone, right? Like everything is either a purpose-built rental, $1 million single-family home or more, or like, a standard condo that you would get into, like a high-rise condo or a condo townhome. Like there's nothing really in that middle ground, like the semis, the row towns, like freeholds and things like that. So this is like kind of lends to that, right? If there's that much more supply of purpose-built rentals and rental units, and the average rent should continue to decline as we go, which is not a bad thing. But we also need to offset. I think he made a very good point that there's kind of that middle income, middle class kind of home is gone. Like it just doesn't, like there's not many of them unless you're getting a resale. And he talked about why, the older demographic. I touched on this on the solo episode. They're 250, the big 250. I touched on this ad nauseum, so I don't want to get into it too much, but we hadn't talked about it. So I thought this is all kind of, it all makes sense. It all adds up.
Well, plays into inflationary numbers. Rent is in those inflation numbers. And so that coming down certainly is helpful, but it doesn't, them slowly coming down over time and the reduction in rental rates. So it's not by leaps and bounds and hundreds of dollars a month. Whereas for oil prices having come up at the pumps, coming up so drastically from a percentage basis, and even from a cents and dollars basis, that drives and bumps inflation numbers even more so. So it'll be interesting to see, kind of not even interesting. It'll be kind of almost scary to see over the coming period as to how this is impacted, and hopefully this conflict obviously resolves itself, like any conflict resolves itself, sooner than later. Having these kind of ongoing is not good in any way, shape, or form for humanity or for markets. But we'll kind of see. But coming up, today is Wednesday, the 11th. I think right now the bond market is being driven by this conflict and by news, not so much by data, aside from the oil prices. But today in the U.S., because we are very closely tied to the U.S. market, we have the U.S. CPI for February numbers coming out today. We've got the U.S. jobless claims coming out tomorrow, the U.S. core personal consumption expenditures. So that's coming out for January. It's delayed, but that's coming out Friday. And the U.S. GDP numbers, their Q4 revision of last year, coming out on Friday. So, and then in Canada,
I have the numbers here for
we've
the
got
CPI.
our employment rate. Yeah, we've got our Canadian employment report for February is coming out on Friday as well. So there's a lot of actual figures and more so out of the U.S. and then our jobs numbers that come out Friday. But it'll be interesting to see what those numbers in the U.S. look like, because that's real data that's going to drive the markets, and not just in the headlines of news of this conflict. So we'll kind of see how, I guess, really over this week, how the bond markets react to those.
Yeah, so CPI numbers in the U.S., came out this morning. It says consumer prices broadly remain unchanged in February, holding steady just before war with Iran rattled markets and threatened to wear a hole in America's pocketbooks. The consumer price index increased 0.3 in February on a monthly basis and 2.4 over last year, matching economists' while showing little change from January's cooler than expected print. Pretty much Right on. On a core basis, excluding volatile energy and food categories, consumer prices rose 0.2 from a month earlier and 2.5 from a year ago, also matching economist predictions. So pretty much what they expected. The markets, though, today are seemingly doing really well. Now, they took a big hit, obviously, since the conflict started, but, markets usually tell the story. So, follow the money. That's usually what they say. Trump made a comment yesterday saying that the war is almost over on, I think it was CBS or something. And there was $1 trillion moved in the market just from him making that comment. So there's money waiting. So if you see the market going up, they might know something we don't before it hits the public,
but it's also,
news,
I mean, it's shown since he's come into office that he
it's
can
a roller coaster.
he can tweet something and
it's
the
great.
markets move by trillions, which is wild.
It's so
That's all based, that there's movement based up and down on tweets, which is outrageous.
I saw this funny,
shows how fickle
meme.
people are.
I saw this funny meme. It was like, before, and it was like this guy analyzing all these charts and numbers and stats. And this is now, and it's just like an X post with Trump. It's just like whatever he says, that's like moves the markets. There was one more thing that you wanted to touch on. So people always ask, like, what's a level 2 license? And, we can, the name of them, we've said it many times. It's not the greatest, not the clearest identification, a level 1 or level 2 agent. But as a level 2 agents, we do have access to kind of like alternative and private type lenders, which lend to different applicants, really, not even necessarily bad applicants, just different structures, different credit history, et cetera. So I wanted to just kind of explain, and maybe we can just have a quick conversation about this, Dave, about like, is a private lender, how do they work? How does it differ from like your Schedule A banks? And then OSFI's changing some rules about blanket appraisals. So maybe we can just go on a bit of a tangent here about all of those factors,
There's not much in there at all to talk about.
It'll be short tangent.
So in mortgage lending, there are a few different categories of lenders. You've got your A lenders, which would be your major banks, your monolines, which are mortgage-focused banks. Then you've got your alternative lenders or your B lenders. These are kind of a step up, obviously. These are more so for people that are self-employed. Maybe you're a taxi driver, maybe you're an accountant, maybe you're commissions, a realtor, a mortgage broker, maybe, sales, whatever it may be, and you're incorporated or you're self-employed and you're not claiming as much on your personal income and because you're keeping, accruing within your corp. And so qualifying with an A bank, they go off your T1 generals, your notice of assessments, whereas these lenders have programs per se that can help with, going off of bank statements instead and kind of more programs like that. Or you've got a little bit of a bruised credit or your qualifying ratios are higher. Then you move into a C category, which are into kind of more of the, you've got more kind of private lending, which is more your mix or your mortgage investment corporations. These are very much more flexible. They're all balance sheet lending. They lend from a pool of private investors. And typically they're in the, few hundred million, to $1 billion range as far as assets under management. But they're very flexible as far as what they're qualifying. And it's more common sense lending as far as the situation. Somebody hasn't sold their home yet. This is one I just submitted this morning, for example. A couple built a new home. They haven't sold their existing home. They need funds. They've paid for half of the build themselves. Their builder holds half of the mortgage right now as a first mortgage that, at a high interest rate. They have their home listed. They can't qualify with their major bank for a new mortgage to pay out that high interest contractor on their existing property. And so and they have very good income, all of that, but their qualifying ratios are too high for your traditional bank. And so, I'm able to qualify them with an alternative lender as a short-term solution, get them into a lower interest rate, more manageable payments, pay out that builder. And when their current home that's listed is sold, they pay down the mortgage and we roll them into a major bank. So that's kind of an example on that lending side. And then you've got true private, which is a lot of times like one-to-one lending. I need a mortgage for whatever reason, like short-term solution. Sometimes it could be back taxes owing. Sometimes it could be, whatever, debt consolidation or consumer proposal, whatever it may be. And Paul lends David money. And usually that's like handled through lawyers, et cetera. Obviously, in that regard, it's still registered on title, but these are all the different kind of categories in short. Yeah. So with those different lenders, and you've got a broad range, you were mentioning level 2 agents, which again, the name of them is ridiculous, but level 2 mortgage agents have the ability to tap into those other alternative lenders in order to help different clients in that regard. What is, kind of in the issue right now that's coming up in some markets like Toronto, Vancouver, Toronto, especially with the condo market, with prices being down so drastically, that's now pushing some of these mortgages into 100% loan to value, because what those private lenders lent on originally was, say maybe 70% loan to value, and now the values have come down 30+%. And so the lender is now at what they've lent on that property is now at its value, which kind of creates a massive risk for that lender, because there's no exit, for that client. So whenever we're talking about these alternative lenders to a client, and in this market is, really it's a short-term solution, and there's a clear exit strategy. It's, clearing up credit, or, their credit bureau by clearing out some debts and consolidating that, and now rebuilds their credit. Now they qualify to move over to the A side, or that, like I mentioned, they haven't sold one property, so they're having to go into with a private lender and move in another. But in markets like Toronto, where they've had to go into a private lending because they just haven't qualified elsewhere, now they're at 100% loan to value. It's creating this problem, because there is no exit. And as much as a private lender can say, well, I want my money back, my term was 1 year on this mortgage, if the borrower's been paying the mortgage all along, there's not much recourse that they can have in that regard. And also that borrower doesn't want to foreclose on that property, because there's no meat on the bones, if you will. Like, it's over leveraged already. And so it's creating this underlying problem in some of these markets that, these lenders can't get out of these properties. And so it's going to take some time to really kind of unravel that issue.
That's a great summary, Dave. Great explanation. I hope that was educational for a lot of people. I know it's a very common question, like what does this mean and what can you do differently and stuff. So I think that's a very good summary. Lastly, Dave, I wanted to just touch on the February stats. Got these, meant to go over them last week, but here they are. The most staggering thing here to me is the days on market from January to February. January, which I know it says February, but this is January, 49 days on market in January, 24 days on market in February. That is a substantial drop in days on market. New listings in February, 1582. Benchmark price, 693,200. That's up from 683. Days on market, 24, down from 49. Active listings in February, 2928, up from 2673. Benchmark price for apartment, 385.5, up from 380. And properties sold in February, 780, and that's up from 610. So between the benchmark and the days on market, to me, that's like a pretty big jump up in values. Like, considering, everyone kind of assumes that prices are stagnant or decreasing. I said, I think a month ago that, we've missed the bottom. Like, the bottom has happened. Now going into the spring market and leading into this year, like, I think come August, that single family home is going to be over 700. It's just a matter of time. Like, the spring market is going to show where prices are. But I think month over month, that's a dramatic increase. 10,000 for single families. I think it was 5,000 for condos there. And then the days on market literally cutting in half is pretty substantial.
Yeah, the 24 days on market is really interesting. And like you said, dropping from 49 to 24 is pretty wild, and just shows the level of activity. That's people taking their properties off market, saying, you know what, I'm not going to bother. Maybe they had a rental that was up for maturity, and they're like, you know what, I'm just going to rent it out and keep this and renew it. And they were hoping to maybe sell it, so they remove it, but that's inventory off the market as far as resale. So it's shrinking that market. Typically, it's the most number of properties, I believe, is kind of end of March that people start listing, kind of coming back from March break, and as spring starts hitting. So I think, really over March, it'll be interesting to see how that level of listings increase or not, and kind of what happens there in that regard.
I can't hear me. Why don't we slide into some boosts, David? What do you think?
Let's do it.
End the show with some boosts. All right, I got 3 today. Number 1, did you hear about the bankrupt poet? He owed everyone. Number 2, spent a lot of time, money, and effort childproofing my house, and the kids still get in. For someone with two adult kids.
Speaking of kids getting in, we've got a
perfect.
we've got a guest.
Perfect timing.
Yeah.
And last but not least, breaking news: a British guy stabbed the 12th letter of the alphabet several times yesterday. Bloody hell!
Wow.
I love that one. Bloody hell! All right, thank you, everyone. We're back. We're a day late. We apologize. We're here. Guest coming 2 weeks, Sean Cathcart from Korea. He's their, I believe, director of statistical analysis.
Their stats guy. He's their stats guy.
Stats guy. He'll be on 24th, and otherwise, we'll be back next week. Thank you for tuning in. Thank you to our amazing sponsors, and have a great week. See you soon.